everyone, this is Mrs. Miller, and I wanted to go over an example of discarding assets for you. So far in our chapter 10, we have talked about depreciating long-term assets. Here we're talking about what happens when that estimated life of the asset has passed. Once we are done with the asset and we either sell it or discard it. So I'm going to show you 4 different journal entries. You'll see that they're quite similar in how we tackle them, but I don't have enough space here to do all 4 of them on one, so I'm going to make you 4 different videos to walk over each one of our 4 scenarios. The very first one is what happens when we discard the asset as having no value whatsoever. So first, we have to look at the problem, and I have given you all the details because my board's kind of small. I've given you all the details in Canvas to the problem itself. It says we have a truck, it cost us $49,000, and we have $39,000 of accumulated depreciation on that truck. So we're recording discarding of it. We're getting rid of it as having no value. So we do some basic math. We had $40,000 or $49,000 as our cost and $39,000 as our accumulated depreciation. So that tells us we have a market value, carrying value, residual value, they're all kind of the same thing, of $10,000 on this truck. What we're essentially doing is wiping out the previous T accounts and the accounts on our records. So I have those T accounts listed up here. And if you remember during our closing entries in Accounting 101, we actually do the opposite to close it out. Like the truck has a $49,000, it's a debit, of course, because it's an asset. So it had a debit balance of $49,000. And our accumulated depreciation account has a credit balance of $39,000 because it is a contra asset account. So how do we get rid of this? Well, again, back to your closing entries, we have to do the opposite. That means this, we're going to have to give a credit of $49,000 to wipe out that account, and we're going to have to debit accumulated depreciation $39,000 to wipe out that account. So let's actually do the journal entry here. We've got the date. So we've got January 1st. Let's put it down here. 2019 is my date for my journal entry. My asset, it's not an asset, sorry. My debit is the accumulated depreciation because we need to close out that account. So it is accumulated depreciation, and it is for $39,000. You want to skip a line here because we know there's a difference in our quantities. Then we have to actually give a credit of $49,000 here for the truck to wipe out that account. So truck is $49,000, and then we should have our reasoning down here to record disposal of truck. It's fine. Okay, but now from journal entries in Accounting 101, we know that this is not a proper journal entry only because my debits and my credits don't match. So we have a truck that's valued at $49,000. We have $39,000 of accumulated depreciation. That means we've lost $10,000, and that's all we're really going to call it. We have to understand this carrying value, what's left. So we're literally going to record that, and this is in your textbook, an example of these journal entries. We're going to put loss $10,000. Now this journal entry makes perfect sense. We have a date, we have 2 debits and 1 credit, but they match because we have $49,000 here, $49,000 here, and a reason. We just disposed of this truck and got rid of it. And that is the journal entry for having discarded our asset as having no value. Look for the next video.